Hi grade 12, I'd like to welcome you to the first video in my accounting channel. I'm going to attempt to follow the order of the syllabus, working through either teaching content, otherwise some practical worked examples from past papers. Today I want to focus on company ledger accounts, starting with the sale and repurchase of shares, then we'll look at income tax, and finally we will look at dividends. Alright, the best way for me to do this is by means of a worked example. So if you have a look here, you are given some opening balances on the 1st of March. You have ordinary share capital, 500,000 Rand, and they tell you that the average issue price is 2 Rand per share. If you divide 500 by 2, that will mean we have 250,000 shares that have been issued so far. You then have a retained income balance. Retained income is that income that's kept, or that part of profits that's kept by the company from previous years. In other words, it's not used for dividends or tax. Right, look at the first transaction. Sold an additional 40,000 shares at 7 Rand each. To calculate the amount, you'll take 40,000 and you'll multiply by 7 Rand. Share capital will obviously be increasing because you've sold more shares. And the other account that is affected when you sold those shares will be bank. Then on the 29th of February, we repurchased 5,000 shares for 8 Rand each. Whenever you deal with the repurchase of shares, the first thing you need to work out is the average issue price. So to do that, you were told the average issue price was 2 Rand here. However, it is going to change now because we've sold more shares. So to calculate the average issue price, you take the total amount of money you've received, which is 780,000, and divide that by the total number of shares, which is the 250 plus the 40. In other words, 290,000. So that gives you 2.69 Rand per share. But the price paid was 8 Rand. The 2.69, the average issue price, must be the amount that comes out of share capital. So if you take the 2.69 times the 5,000, that 13,450 will come on the minus side of share capital, and you paid money, so your details here will be bank. Everything in this share capital account, when you buy back shares, must be at average issue price. If you don't do that, it will look like you've bought back more shares than you actually have. Because if you took 5,000 times 8, you'd put 40,000 here, which is not actually the value of those shares according to what you had here. The extra bit that you paid here, and remember, you're going to give the shareholders some sort of reward if you buy back their shares. Okay, you buy back their shares, they've invested money in your company. During the time that they've invested money in the company, your company's made profit. So you're basically rewarding the shareholder, giving them a share of some of the profit or some of the retained income. So you take the 5.31 times the 5,000, and that 26,550 comes on the minus side of retained income. So reward shareholders for investing their money in the company, give them a share of the retained income. Just a couple of things regarding buyback of shares. Please remember, you cannot buy back shares if you are going to end up with solvency or liquidity problems. And the other thing you must remember is that once those shares have been repurchased, those shares are retired. So you cannot sell those shares again at a future date. Okay, the next thing we're going to look at is income tax. The company is regarded as a person in the eyes of the law, and therefore when it makes profit, it has to pay tax on that profit. The company is required to pay provisional tax. So in other words, they have to pay tax twice a year in advance, and they base that on the expected profit. If we have a look at this example here, SARS income tax starts off with a credit balance of 9,200. That credit balance means last year we did not pay enough tax to SARS because we owe them money at the beginning of the year. If the balance was on the debit side, it would mean last year we overpaid tax. In other words, SARS would owe you. Right, then we come to the transactions. On the 14th of March, we repaid the amount owing to SARS. So you take the 9,200 and you pay it back, taking your liability down to 0. Then, as I said, you're going to make 2 provisional tax payments. Now that provisional tax is tax paid in advance, and it's based on the profit you expect to make. At this stage, SARS is regarded as an asset because you paid that tax in advance. If you don't make a profit, or if the company closes down, then SARS owes that money back to the company. So at this point here, SARS would be an asset. You then get told the tax expense for the year. Now the tax expense for the year is the amount of tax that you should have paid. So in other words, they're telling you now you should have paid $250. So you credit SARS, that's what you owe SARS. But can you see you've already paid $240 of that? Which means we actually only owe 10,000 Rand to SARS, which will be your balance that you're going to bring down at the start of the new financial year. So this account gets balanced at the end, and in this case, our tax expense exceeded our provisional tax payments. The double entry for this income tax here is on the debit side of income tax. So as soon as you know the tax that you're supposed to pay, that's when you use your income tax account. You debit it because it's an expense and you show you owe it to SARS. If we had paid, for argument's sake, $270 here, then SARS would end up with a debit balance, making it an asset, meaning SARS owes the company. After you've done your adjustment, your final step in your accounting procedure is to do your closing transfers, and income tax gets closed off to appropriation. Please note, the tax expense for the year is what ends up in the appropriation account. Okay, then thirdly, your dividends. As I said to you, the profits that are made by a company belong to the company, but they can let shareholders share in those profits if they pay out a dividend. Okay, the dividend, you get interim dividend and final dividend. Your interim dividend is declared by the directors, approved by the directors, and paid immediately sometime during the financial year. That's interim. Your final dividend, on the other hand, is a dividend that the directors declare. They then go to the annual general meeting, and only once that dividend is approved is that dividend actually paid. So in this example where we have shareholders for dividends here having a balance, that 39,000 is last year's final dividend. And they then tell you that you pay the amount owing to the shareholders. In other words, you pay back your liability. Right, then we come to paid and interim dividend. Dividends on ordinary shares is an expense to the company, so you're going to debit it. Your details for this one, because it was paid, will be bank. Then they tell you declared a final dividend of 120,000. That is also an expense for the current year, so you record it in dividends, but this time you show that you owe the shareholders the 120,000. So there's that double entry for the 120,000. You debit the dividends and you credit shareholders for dividends. Now usually you will get told paid a dividend of, let's say, 15 cents per share. Remember to calculate the amount, take the number of issued shares times by the dividend. Okay, and then after you've done your adjustment, which is this one here, you then close off, and this goes to the appropriation. So please note the amount that goes to the appropriation. It's the dividends for the current year only. Interim 180 plus final 120. So if we have a look at an appropriation account now, this account starts off with your net profit. That net profit would have obviously been calculated in your profit and loss account. Now the net profit gets used for two things. It gets used for tax and dividends. It's very important that you know which amounts to record here. The income tax amount is the tax expense for the year, or as I say, the tax that you should have paid. So if you go back to the above example, the tax that you should have paid, remember, was $250. So that is what you would record for income tax, the $250. Then coming to the dividends, it's the total dividend for the current year. In other words, your interim dividend plus your final dividend. So if you're doing this one, that amount would be 300,000. At the end, once you're done with all this, you work out the difference between the two sides. If this side is bigger, to close this account off, you will put the retained income on the debit side. Okay. If, however, your net profit is lower than your tax and your dividends, then that retained income would have to come on the other side. And if you look at that, if you credit here, that's going to mean in your retained income right up here, you will debit it. Can you see that's a retained loss because you're decreasing your retained income? Alright, I'm not going to do any other examples on company ledger accounts because this seldom gets asked in matric finals. However, it's important that you understand the entries in this, especially as you move on for during the year, doing financial statements, cash flow statements, etc. So go through these ledger accounts, make sure you understand them, and then you're going to use that knowledge later on in the year when we move on to financial statements. Right, that's it. Thank you very much.